Okay. Bias is it's one of these sort of funny ones because there are different ways of looking at bias in terms of like who's in control and everything. Um, the simple thing is that you can trade either with or against the market. Once you can read the order flow, the price action properly, it really doesn't matter whether you're going long or short at any given time. But it will impact on targets, and it probably will impact on, I think on the whole, if you're trading with the market, you'll get bigger R trades. But when you read this sort of always trade with the trend stuff, I mean, that's complete rubbish. There are no trends in price action trading. That's just a retail myth. Proper traders aren't saying, "Oh, well, I'm only going to trade it if I can see an uptrend or a downtrend." You can look at either side, but we'll look at an example of how bias can be helpful. Now, I didn't trade this particularly well, and I'll sort of put my hands up to that now. But this is dollar yen. I mean, I really wasn't on my game yesterday at all. I don't think I made a number of mistakes, but this is probably the worst one. And really, bias. I think I was discussing the curve a couple of days ago, and you may have thought, "Oh, what on earth is he talking about?" Curve is essentially, well, actually, let's curve would be, as an example, if price hits, in this case, weekly supply, it is likely to go to weekly demand, which I think is probably going to be this down here. Okay, so the curve for a weekly move would be from here down to here. So that's what we should expect to see on the weekly chart over the next 2, 3, 4, 5 weeks or whatever. And so when I talk about curve, I'm talking about price moving between, in this case, a supply zone and a demand zone. This obviously gives us a short bias, that we're more likely to see shorts than we are longs. And if we drop down to, I'm just going to change the colour on this just so that we keep things nice and simple. I'll probably keep saying this, but at the end of the day, it's not massively important that you get too worried about bias. A lot of this stuff, we are looking at some more advanced stuff now, and it may be stuff I've covered quickly in the past, but some of this stuff will just start to come naturally. The more you look for it, the more you'll find it. So as I say, we've got the start of what probably looks like a weekly move. We'd need to see the first opposing demand consumed, which probably looks like it's going to be this level here. So I'd say, we with a fair degree of confidence, we've got a weekly sort of bias from supply down to demand. I have no idea how long it'll take to get there, but that's a fair assumption. Now, that might say, okay, well, I'm only going to look for shorts. Well, that's pointless because, of course, there would be lots of longs along the way. This is a weekly curve, and we're trading a lot of the time off M30 and stuff like that. But I want to sort of explain how bias, and this is one I got wrong. So you sort of have to do what I say rather than what I did. But price hit supply, H1 supply yesterday afternoon or yesterday morning, and we've got. It's very difficult to see actually any H1 demand until down here. DB, I know I said use this level. That's the level I used, but this is the correct level. There's no rally-based drop there, but there is a rally-based drop here. So this is the H1 curve from supply down to demand. Now you could say, well, isn't this a demand zone? Well, not really, because look, all it did was it went up straight up to this supply. If it had consumed this supply, I would say that was important demand, but it didn't do that, so it's not important demand. You could argue that there is a flip along here, maybe, but it doesn't look that great to me, and I didn't have it marked. Maybe I should have done, but the important thing is, as I say, I think we're trading from this supply down to this demand. Now that means we've got a short bias on H1 from supply down to demand. Okay, it doesn't matter what's going on the weekly. I'm just looking at that we've got a short bias, and that's why I took the SDC that I did, because I've got a bias. I'm expecting price to drop, so if I get an SDC as formed here set up, I'm going to take it because it's in line. Going back to this curve, if the curve is from this supply down to this demand, or even if it were to demand that flip demand I talked about here, the fact is that there is space between this supply and price hitting H1 demand to be looking for shorts. And an SDC is it's a consumption trade, but you could also call it continuation trade. Now I'm now going to jump into something else while I remember, because hopefully what I've said so far makes sense. But now we get what a lot of retail traders will call I can't remember what they call it actually. Is it a descending triangle? I don't know. But anyway, you understand the concept of price dropping strongly, then we get the lower high in there. We've got price pressure, prices going down. Now, this next thing is something I don't think I've explained before, and that is, as you know, in order for us to see price rejection, we always be looking for the first opposing supply demand to be consumed. Now that's for price rejection. This is this is SD consumption. So up here we'd be looking for rejection from supply. Down here we're looking for consumption from demand, because we're expecting to move further down. Now when you see this low form here, this low is not demand. Okay. Now very often it'll be a lovely sort of SR level, and again that SR level is not demand. Okay, a demand zone is a rally based drop or a drop based rally. It is not a swing low. What is important is that there will be demand to the left that created this swing low, that made price bounce up like that. And this is taking SDCs a little bit further than we've taken them before, because you can see here we've clearly got demand here, and that's what's created this swing low. So in order for this breakout trade to work, well in fact it's a break and retest, we need to see the demand that created that swing low consumed, which is what happens here, before we enter. Okay, very important concept. Now if you were to go and look at every single SDC example that I've posted in our thread, you will find every time, if you draw a line at the swing low, you will find, well I say every time, sometimes it's invisible, but most of the time you'll be able to see an SD zone usually on a much lower time frame. So like in this case we can actually see it fairly clearly on M5, but very often you'd need to drop to M1 and you'll find a little demand zone that created this swing high, and that's what needs to be consumed for the breakout to work. Okay, as I say, this is going a little bit further than we've gone before, but what you need to understand is this here, and I'll put it in a different color. The pattern tells us what's likely to happen next. So we got the lower high, then we get the strong break. It's the classic SDC pattern. But the important bit is we need consumption of this demand, which we could call the first opposing demand. We need that consumed before the pattern will actually start to work. Okay, and this is obviously not stuff you're going to find on the internet, because retail pattern traders haven't got a clue about this sort of stuff. So it's quite an important concept, and it's worth thinking about. Don't take my word for it. Go and look at all the SDC examples. I have specifically not gone into this before, but I feel that it's important that we do actually cover this, because I know for some of you who are getting to be quite forensic in the way that you're looking at this stuff, you're going to want to understand this. Okay, so this is we've moved from curves to SDCs, but there is a link, and that is, of course, never ever trade. If you're going to trade an SDC, you're always trading it inside a higher time frame curve. In this case, the higher time frame curve is this H1 supply to H1 demand, and this is why I can't remember. Someone was asking me about. Someone was asking me about taking a potential SDC up here. Well, the thing is, inside what curve are you going to be taking this? Because you just hit W1 supply, so you'd need to be inside a monthly up curve. So I'm not explaining that very well, but the point is, when you're taking an SDC, it's always going to be inside a higher time frame curve. I hope that sort of makes sense. For some of you, I may be going a bit deeper than you want me to go, and apologies for that. But for others, as I say, who are looking at things more forensically, I think it's probably important that you understand it. Here's another curve that I know well. Both DB and I were trading yesterday afternoon. Let's put that like that. Once you get rejection from this zone here, what's price going to do? It's going to move down from supply down to demand. So actually looking at this, I probably would actually say the curve for that first move is from there to there, although it has got a lot further. But yeah, the curve from here, once you get rejection from this zone, will be down to here. So if we, obviously there was the FB that DB and I took, but then you could be looking to try and get an SDC. I don't think there probably was one. Let's have a look. Yeah, there's a sort of SDC there, but not a great one. And there is the danger, of course, that so actually ignore it. There wasn't an SDC. I'm not going to go into why, but it was hitting this first, and so arguably the curve ended here. Sorry, is what I was trying to say. But yeah, again, when I talk about curve, I'm simply talking about the space or the distance between one high time frame SD zone and another. When I'm talking about bias, I'm talking about price traveling between SD zones. So here we have an H1 bias, again short. Here we have another H1 bias, short. On the weekly, we have a W1 bias, short at the moment. I don't think we've got a daily bias. Well, not really. No, it's the weekly bias. Now, of course, if price hits this daily demand and starts going up, then we'd have a daily long bias. So you can have a weekly short bias and a daily long bias. This is the thing. Don't try really hard not to overthink this stuff. Otherwise, you'll tie yourself up in knots and never take any trades. Just over time, this sort of thing will come naturally. the more you see it and the more you get used to it. But so primarily the important thing about bias is that it can help with targeting. Because you could say, okay, well, we're in a clear, obviously there is a short bias, prices moving from W1 supply. If I was short from up here, do I expect new lows? Well, yes, I probably do, which is why you might look to run the trade. So yeah, that's all I've got to say on bias. I've also given you a little bit more on SDCs and how why these triangles and wedges and stuff form. I'm going to try and put together some more stuff on QMs a little bit later this morning.